Welcome to The Explainer. We're diving into a market that is sending some seriously mixed messages. It's this real battle between strong economic data and, well, a whole lot of fear.
So you've got this one side of the story, right? All this powerful economic data that's basically screaming everything is great. But then, on the other hand, you've got this fog of geopolitical uncertainty that's making everyone anxious. The big question is, which one's real? Is it the signal or is it just noise? Let's try and unpack this.
Okay, so first up, let's look at the signal. We're talking about the hard data here. The numbers that are pointing to an economy that's, not too hot, not too cold. It's just right.
And wow, the first piece of evidence is a big one. Check out the ISM Services PMI. This number basically measures the health of that huge services part of our economy. Everything from healthcare to restaurants. It just shot up to its highest level in more than a year and a half. That points to some really robust, accelerating growth.
But here's where it gets really interesting. When you look inside the numbers, what we're seeing is that new orders are just booming and employment is expanding. And get this, at the very same time, the prices paid part of the report, which is a huge indicator for inflation, actually fell to its lowest point since last March.
And that right there, that perfect mix of faster growth and slower inflation, that is exactly what economists call a Goldilocks economy. It is the absolute ideal scenario, the thing policymakers are always hoping for.
And look, the crucial thing to understand is that this isn't just some one-off fluke. We're seeing the exact same cooling trend in the job market. That extra pay that people were getting for switching jobs, it's just dropped to a record low. Now that is a powerful, powerful signal that wage-driven inflation, something the Fed has been really worried about, is finally starting to lose its momentum.
Okay, so if the economic signal is that clear, why is everyone so anxious? Well, that brings us to the other side of the equation, the noise. And it's a loud, disruptive roar of fear coming straight from geopolitics and all the policy uncertainty that comes with it.
Yeah, the conflict in the Middle East has just completely changed the entire conversation. All of a sudden, the market is terrified of a huge spike in oil prices, and that could do two bad things at once: slow down growth and fire inflation right back up. That's a nightmare scenario called stagflation, and trust me, it is the worst of both worlds.
And you know what? This confusion is happening even inside the Federal Reserve. You've got the hawks, people like Neil Kashkari, who are saying, whoa, hold on, let's wait and see what this does to inflation. But then you have the doves, and they're arguing that the bigger picture, that cooling trend in the economy, is what really matters, and that they should just stick to the plan for cutting rates.
And this internal division? It's had a direct, measurable impact on what the market expects. Just a little while ago, a rate cut in June was seen as a pretty good bet, better than 50-50. Now, those odds have totally cratered. They're down below 44%. The market is now pricing in a delay.
So this clash, this battle between a strong economy and all this geopolitical fear, it's forcing investors to basically throw out the old playbook, and the market is starting to behave in some really strange, kind of counterintuitive ways.
Think about it. In a crisis, what's the first thing investors usually do? It's textbook, right? They run for the safety of government bonds. But that's just not what's happening this time. The traditional flight to safety play, it's just not working.
Right. Instead of buying bonds, investors are actually selling them. And that means bond prices are falling and their yields are going up. Why? Because they're more worried that war could fuel inflation and balloon government debt. And that fear is now overriding the typical desire for safety. This completely breaks that traditional relationship between stocks and bonds.
So if the money isn't going into bonds, where is it all going? Well, it's flooding into the US dollar. The dollar is acting like this giant vacuum cleaner, just sucking up capital from all over the world. It's creating this powerful American exceptionalism theme, where US assets feel like the only safe game in town.
And the effect of this is just stark. Look at this. While US markets have shown this incredible resilience, international markets, like South Korea's KOSPI, just got hammered. It dropped nearly 20% in just a couple of days, as all that global money fled for the relative safety of the dollar.
Okay, but while everyone's eyes are glued to geopolitics and the Fed, this report argues that the biggest risk might be something else entirely, a systemic danger that the market seems to be completely ignoring.
And that danger? It's lurking in the absolutely massive and kind of shadowy world of private credit. We're talking about a $1.7 trillion market where private funds, not banks, are lending money directly to companies, and has just exploded in size as traditional banks have kind of pulled back.
And a really stark warning is coming from someone on the inside. Mark Rowan, who heads up the investment giant Apollo, is predicting that default rates in this sector could just skyrocket to a staggering 15%, especially for funds that loan money to software companies that are now really struggling under the weight of these high interest rates.
And listen, this isn't just a theory. We're already seeing red flags. A major credit fund over at Blackstone has reportedly started limiting how much money its own investors can pull out. That kind of freeze on withdrawals, that is a classic sign of distress. It really echoes what we saw right before the 2008 financial crisis. You have to ask, could this be the black swan event that nobody's watching for?
All right, so what does this all mean? How do we even begin to navigate a market that's being pulled in so many different directions at once?
Well, the report basically lays out two very clear paths forward. You've got scenario A, the bullish case. That's where all this geopolitical noise fades away, oil prices calm down, and that strong economic signal, the Goldilocks scenario, wins the day. Then you have scenario B, the bearish case. The conflict gets worse, oil spikes past $85, and the Fed is forced to keep rates high to fight off inflation.
So where does that leave us? The final verdict from the report is neutral with an upside bias. Now, what that means is that the underlying economic fundamentals are probably strong enough to provide a cushion against all the noise, so it's cautiously optimistic. But, and this is a big but, it comes with a clear warning that those hidden risks, like the ones in private credit, are very, very real.
So, to cut through all this complexity, what's the one thing we should actually be watching? What's the one number that's going to tell us whether the signal or the noise is winning this fight?
Well, you know the saying, fear can slash prices in the short term, but liquidity and earnings, the fundamentals, they ultimately decide the trend. When everyone is distracted by falling missiles, the smart money focuses on cash flow. And right now, the most important fundamental to watch is jobs. That's why the one piece of data you need to watch is this Friday's non-farm payrolls report. It's going to tell us that the labor market is truly cooling off, and that will guide the Fed's next decision, and ultimately, it's going to set the market's real direction. Thanks for watching The Explainer.